Mark Cuban has invested in a crypto project called Titan, and it has lost more than 99.9% of its value in a single day. The worst case scenario for an investor, something fairly rare even in the volatile cryptocurrency marketplace. This story is fascinating, but it's fairly technical. So I decided, you know what? Let me just go ahead and attempt to explain what happened to Mark in more simple terms. That way you as an investor can avoid making the same mistakes. Now, I don't want to make this to make people think like if you buy into any old cryptocurrency, like it's going to just crash down to 99.9 or crash down 99.9%. What he was doing was much more technical and much more high risk than the average crypto investor. But it's important to understand what he was doing and what we can learn from it. Heck, I mean, even if you're not an investor, this is still a wild story. So just buckle in because you'll learn something and you'll be able to be like, wow, this is pretty crazy. So Mark Cuban has been participating in yield farming for some decentralized exchanges, and he's quite excited about it. So much so that he actually wrote a blog post only 3 days before this 99.9% crash, and he was touting the wild returns that he was getting from yield farming. We're going to do some definitions here before we go into the blog post. So first off, decentralized exchanges. These are essentially cryptocurrency brokerages. So a brokerage is a middleman that facilitates the trading of assets. So a brokerage would be an example like Coinbase or Charles Schwab or Webull, which is linked down below. You can grab 2 free stocks. So that a brokerage is that middleman. But with a decentralized exchange, instead of this centralized brokerage like Coinbase, it's run by a smart contract. A smart contract in the middle. So decentralized exchanges, or DEXs, as they're also called, offer higher security, higher transparency, and lower fees than centralized exchanges. They really are the future. We will see this much more in the future. And then yield farming. This is a pretty complicated subject area, so I'm just going to do a top line overview. But basically within a DEX, within a decentralized exchange, you need money, aka liquidity, to help facilitating trading the deals from buyers and sellers and through the smart contracts. So people will add funds to what's called a liquidity pool to help fund the operations within the DEX, within the decentralized exchange. These people are called liquidity providers, or LPs for short. In return for locking up funds and putting them in the liquidity pool, LPs are paid out a reward, and that is what Mark was doing. So now that we know the definitions, let's go over to the blog post here. And it's titled The Brilliance of Yield Farming, Liquidity Providing, and Valuing Crypto Projects. So I want to scroll down here quite a bit. There's just a little bit that I highlighted that I wanted to cover. So Mark said, I'm a small LP. He's a small liquidity provider for QuickSwap. I provide 2 different tokens, DAI/Titan, that enable QuickSwap to offer swaps between these 2 tokens. So Titan is that coin that tanked. And here is Titan. You can see it was up as high as $52 here. I heard that it went up to $60, so it must have just very briefly went up to 60. And now it is a penny. It is nothing. Far less than a penny right now. So 99.999% value lost. And also what's crazy about just the crypto market in general. So this token is the iron titanium token. There's another token called Titan, and just because of all this wildness that's going on, look at this. It's up 381% just because of the name. Insane. So going back to the blog post, Mark Cuban was providing liquidity for trades within this marketplace, and his initial investment was $75,000. So for him, that's not much. And we don't know exactly how much he lost, if it was that full $75,000, if it was actually more by the time this happened. We don't know exactly, but that was his initial investment at least 3 days before the crash when he was providing liquidity. And his annualized return here was 206% because he was the only LP, the only liquidity provider in the pool, so he was getting 100% of the fees of the transactions. So if, let's say, there was 10 liquidity providers, they would be all getting a 10% cut, but he was the only one in this individual pool. And this pool was just for DAI and Titan. So just trading DAI for Titan. And then if we scroll down a little bit, now this I just thought was kind of funny, you know, the irony. You have to be careful if you choose to be an LP. Unless you are very experienced as an LP, make sure you do your own research. Make sure the platform has a legit business. And I just thought that was kind of funny. He's like, be careful, but then just went ahead and lost 99.9%. But being an LP is not the reason why he lost his money. The reason why he lost his money is because of the underlying tokenomics of the Titan coin that he was buying into. So Titan is a stable coin. Now, stablecoins are a type of cryptocurrency that pegs its market value to some outside reference. You see some stablecoins pegged to the US dollar. You see some pegged to gold. They could be pegged to any less volatile asset. You could have one pegged to the euro. You name it, you could peg a cryptocurrency to that asset. Now, how they do this is stablecoins are backed by a reserve asset, kind of like how the US dollar used to be backed by gold until 1933. There are a few different methods on how stablecoins can use reserve assets to back its price, and this is where Mark got into trouble. And we're going to explain that in a second here. So stablecoins are cryptos, just as a brief summary, stablecoins are cryptos pegged to some reference price, and they're backed by another asset, and they really aim to offer two things. First, the privacy, security, and processing benefits of cryptocurrencies, and then second, price stability. So the goal is to have the best of both worlds. And stablecoins are nothing new. There are tons of stablecoins. They're used to facilitate trades. They're used to hold money in cryptocurrency before you do trades, just to have a less volatile environment to place your money. But there have been inherent concerns about stablecoins for a while, especially with USDT. There's a lot of concerns there that they're not actually backing it to the level that they say they're backing it to. So now let's talk about a few ways that stablecoins can operate. And ironically enough, this is on the website of the creators of that Titan coin that dropped 99.9%. So there's 4 different ways that stablecoins can peg their value or have the assets backed to the value of the stablecoin. The most safe way is the over-collateralized method. So this is what DAI does. So in order to get $1 of DAI, you have to actually post $1.50, so 50% more of Ethereum to account for things like volatility and issues within the market to keep it extremely secure. So this is the safest way to do it. So DAI would be one of the more safe stablecoins, if not the safest. And then we have a centralized fiat collateralized stablecoin. So this is where you have a centralized operation that will take in money. People will buy their stablecoin, and then they are supposed to buy an asset on the back end to match however much is coming in. And this is where there's concerns with stablecoins like USDT, where they're saying, they're getting people buying USDT, which they can make out of thin air, but then they're not actually getting all the reserve assets on the back end. So in theory, this could work well, but if we don't have the transparency, then there could be concerns, because if it's found like, hey, they only have 30 cents in the dollar, this could tank the stablecoin. Now, again, there's concerns with USDT, but that is currently, as of the recording this, the 3rd largest cryptocurrency. So we do not know what would happen if that were to flop. Markets would absolutely turn if that were to flop. And then we have algorithmic non-collateralized stablecoins. So non-collateralized is there's no actual assets in the back end backing the value of the stablecoin. And basically all that happens is there's some algorithm that is looking at the US dollar and looking at how many people are purchasing that stablecoin and is fluctuating the price of the coin based on those factors. And with the algorithmic non-collateralized stablecoins, there hasn't really been a project that has been extremely successful with this. There's been more flops, at least in this category, than the other categories. And then we have the 4th option, which is the option that Titan was a part of. And it's a combination of the algorithmic stablecoin and a stablecoin that is backed by a real world asset. So it was 25% backed by volatile cryptocurrencies. And the cryptocurrency that they were using is this Titan crypto, the one that Mark bought into, or the Steel crypto on the Binance Smart Chain. So it's 25% that, 75% USD or whatever other backing that they wanted to have. So then this way, they kind of had the factor of not needing so much back-end cash, and it would appreciate their coin, the Titan coin. And the issue here, the inherent issue, is that it constantly needs to grow in order to work properly. As soon as there is a brief sell-off, this can lead to this avalanche of selling and selling and selling all the way down, and that is exactly what happened to good old Mark. And that's also the issue with the algorithmic trading. Of course, just with algorithmic trading, there's more risk there, and we found out that 25% at least did not work in this case. Maybe someone will crack that nut, but it seems like there are many stable coins that have have had issues in figuring out how to do this without backing it by real assets. So it really just comes down to Mark made a simple mistake. He was seeking out very high returns, and with high returns, you have high risk. And I actually have to commend him because I saw this response to this whole debacle in a Bloomberg article. And let me just read it real quick. I read about it, decided to try it out, got out, and then got back in when the TVL, the total value locked, start to rise back up. So he was doing this, got out, went back in, and he was saying that this crypto that tanked was a small portion of his portfolio, which I believe, because he was saying it was like $75,000 in his blog post. And he lost it. He's not happy about it. But in a larger context, it is no different than the risk that he takes in angel investing. In any industry, there's risk that I take on with the goal of not just trying to make money, but also learn. Even though I got rugged on this, it really is on me for being lazy. So I commend him for understanding his mistakes and being like, oh, I should have done a little bit more due diligence in the front end. And this is what happens. This is a learning experience. But we can all learn from Mark's $75,000 mistake. So if you appreciate this video, make sure you give it a like, give me a subscribe. If you like this kind of content and you want more in-depth content, make sure you join the Patreon, which is linked down below. Also check out various offers down there, free stocks, free crypto, tons of cool stuff down in the description. So I would like to thank you for watching, and I hope you have a profitable day.